Hi everyone. When we start an audit, we don't treat every account balances, transactions, or disclosure in exactly the same way. One of the first things we do in audit planning is scoping. The purpose of scoping is to determine whether the area of the financial statement require audit attention or what type of audit procedure do we need to perform. Broadly, we can classify the area as SCOT plus, material only, or others. And then separately, as part of our risk assessment, we determine whether any particular risk should be treated as a significant risk. Now, the question is, what is SCOT plus? Let's start with SCOT plus. SCOT plus stands for significant classes of transaction, account balances, and disclosures. The important thing to understand is that item does not become SCOT plus simply because the balance is material or large. The key question we ask is, what could go wrong in this area and which financial statement assertions are affected? For example, take revenue. Revenue could have risk around whether the sales actually been occurred, whether it was recorded in the correct accounting period, and whether it is complete, accurate, or whether management could potentially manipulate revenue. So when we identify relevant assertions and the risk of material misstatements with an area, that area may be classified as SCOT plus. Therefore, I would describe SCOT plus as a risk-driven scoping category rather than simply a material-driven category. Now the question is, what audit work do we perform for the SCOT plus? Once an item is identified as SCOT plus, our audit work becomes more risk and assertion focused. We first identify the relevant assertions for that particular area. We then assess the risk of material misstatement associated with those assertions. We also consider the relevant assertions over the process. If controls are relevant to our audit approach, we understand and where appropriate, test those controls. We then design substantive audit procedures that specifically addresses the risk we have identified. So the important point is that the SCOT plus, we are not simply saying the account balance is large, so let's test it. We are saying there are specific risks and assertions associated with this area, so let's design our work around those risks. Now move to the next portion, what is material only? Now let's take the second category, which is material only. Material only is quite different from SCOT plus. Here the account is material to the financial statement, so we need to perform audit procedure over it. However, we have not identified particular risk factors that requires us to treat the account as SCOT plus. For example, imagine we have a significant property, plant and equipment balance. The balance is material, but the underlying transactions are straightforward. There is limited judgment involved, and we have not identified any particular risk that would make it as a SCOT plus item. In that situation, the account may be treated as material only. The key idea is SCOT plus is driven by identified risk and assertions, whereas material only is primarily driven by materiality of the balance. Now, what audit procedures do we perform for material only? Even though the account balance is classified as material only, we cannot simply ignore it. Because the balance is material, we still need sufficient appropriate audit evidences. Therefore, we would generally perform substantive audit procedures appropriate to the account. For example, for property, plant and equipment, we could test significant additions, check supporting invoices, test disposals, recalculate depreciation, and reconcile the underlying records to the financial statements. The difference is that we are not necessarily building the same detailed risk-based audit approach around the account as we would do for the SCOT plus. So think of material only as the balance is material, therefore we need audit evidences, but we have not identified specific risks that require it to be a SCOT plus item. Now moving to the third category, which is classified as others, these are items that are neither identified as SCOT plus nor considered as material only items. For example, a relatively small expense account could fall into this category, but other does not mean that we are completely ignoring the account. We still need to consider whether there is any unusual or whether there is any risk that needs to be addressed as a part of our overall audit procedures. Depending on the circumstances, we may obtain audit evidences through analytical procedures, substantive procedures, testing performed elsewhere in the audit, or other appropriate procedures. The important point is that these accounts don't receive the same level of specific risk-based audit attention that we would normally apply for the SCOT plus or material only transactions. Now let's understand significant risk. This is where people often get confused. Significant risk is not another scoping category alongside material only, SCOT plus, or others. Significant risk is a risk classification from our risk assessment. Once we identify a relevant risk in an area, we consider how significant those risks are. Sometimes you identify a risk that is sufficiently high or important that it requires special audit consideration. That is where significant risks come in. So, can we say every SCOT plus have a significant risk? No. But every significant risk is a SCOT plus? Yes. So this is one of the most important points to remember. An area can be SCOT plus without containing a significant risk. For example, payroll could be SCOT plus because there are relevant assertions and risks that we need to address. But those risks may be routine and may not require special audit consideration. Therefore, SCOT plus does not automatically mean it is a significant risk. So to conclude, if you want to remember the whole concept in a very simple way, number one, SCOT plus means we have identified an area where relevant assertions and risks require a specific risk-based audit approach. Number two, material only, which means the account is material, so we need audit evidences, but we have not identified specific risk requiring it to be treated as SCOT plus. Number three, others, which means the item does not fall in either of the categories, although we still consider whether any audit procedures are necessary. And significant risk is different from all these three. It refers to a particular risk that is based on our assessment requires special audit consideration. So the key takeaways, SCOT plus, material only, and others are about how we scope the financial statement items, whereas significant risk is about how serious a particular risk is and how specifically we need to respond to it. Once you understand this distinction, the whole concept of audit scoping becomes much easier. That's it for this video. Thank you for watching. I'll see you in the next video.